You know, when you look at a medical x-ray, finding a broken bone is pretty binary, right? Like it's there or it isn't. The jagged white line is just undeniable.
Yeah, exactly. It's cut and dry.
Right. But looking at the x-ray of global corporate health right now, I mean, that is an exercise in navigating the murky, the deferred, and honestly, the highly volatile.
Oh, without a doubt. It is completely murky out there for a lot of CFOs right now.
And for you listening, there is really no better x-ray of the global economy than the financials of Accenture. I mean, when a professional services behemoth that consults for everyone, from McDonald's to national power grids, reports their earnings, you aren't just looking at a single company's balance sheet.
Right, you're looking at a proxy.
Exactly, a proxy for the discretionary spending of basically the entire Fortune 500. So today's mission on this deep dive is to tear into the raw transcript of their Q3 fiscal 2026 earnings call. This is with CEO Julie Sweet and CFO Angie Park.
And we're definitely bypassing all those choreographed Wall Street pleasantries, right?
Yeah. Oh, 100%. We are here to figure out exactly how the largest corporations on Earth are actually deploying their capital right now. Let's unpack this.
Well, my goal here is to really just translate these Wall Street figures into a clear picture of where technology and business are actually heading. Because the overarching narrative from this transcript, honestly, it's tension.
Tension. I like that word for this. Walk me through that.
Well, you have this immense desire from enterprise clients to just fundamentally rewire their businesses with artificial intelligence, right? But that is running headfirst into the reality of this geopolitical and macroeconomic environment that is forcing chief financial officers to just hoard cash.
Right. They're delaying those massive multi-year contracts.
Exactly. So we have to look at how a company of Accenture's scale engineers its way out of that exact tension.
Let's start with the sheer velocity of the capital flowing through their operations, because it is staggering. Q3 revenue hit $18.7 billion.
Yeah, which is just a massive number.
I mean, that means they're generating roughly $200 million in revenue every single day. But here's where we need to look closer. The 6% growth in US dollars, that looks robust on a headline. But when you strip out the foreign exchange translation, local currency growth drops to 3%.
Right. That's the real metric you have to watch.
So translate this plain language for us. Why does Wall Street care so much about local currency versus US dollars? Because the currency markets are basically mathematically warping the reported revenue, right?
They absolutely are. It's masking a much more sluggish underlying volume of actual work being delivered. The mechanics of that 3% delta are just crucial for anyone trying to understand multinational financials right now.
Because of interest rates.
Exactly. When the Federal Reserve holds interest rates higher for longer, global capital flees to the US dollar for yield and safety.
Makes sense. The dollar gets stronger.
Right. And for a company operating heavily in Europe or Japan and Latin America, the euros, yen, and reals they earn, they just translate into fewer dollars when they report back home.
Even if they did the exact same amount of work.
Precisely. Now, they use strategic currency hedging to smooth out that volatility quarter to quarter. But the local currency metric, that 3%, that is the unvarnished reality of client demand.
So it strips out all the macroeconomic noise.
Exactly. It tells us exactly how much pure consulting and operational volume actually expanded.
Okay, so that unvarnished reality, that flows directly into their forward-looking metrics, specifically the new bookings, because they posted $19.3 billion in new bookings for the quarter.
Which is down about 2% in US dollars, it's worth noting.
Right, and that puts their overall book-to-bill ratio at a 1.0, with the consulting division specifically hitting a 1.1.
Right, the book-to-bill ratio. This is such a critical Wall Street metric for you to understand if you're looking at any services stock.
Right, so a 1.1 book-to-bill means for every dollar they actually billed to a client this quarter, they signed $1.10 in new work for the future.
Exactly. It gives them essentially a 10% pipeline buffer.
But, and here is my pushback, given all the project pushouts we are seeing across the broader IT services sector, is a 10% buffer actually enough to sustain their historical double-digit growth trajectory? Or does that just barely keep the engine idling?
Honestly, a 1.1 in consulting is basically a maintenance metric in this current macro environment.
Just keeping the lights on.
Yeah, I mean, it prevents pipeline decay, but it absolutely does not signal hypergrowth. If you're burning through your backlog faster than you replace it, like dropping below a 1.00, You are effectively liquidating your future revenue.
Which is a death spiral for a consulting firm.
Exactly. So holding a 1.1 indicates that, look, while the velocity of deal flow is definitely slowed down, the underlying demand for enterprise transformation has not vanished. Clients are still signing.
They are just, heavily scrutinizing the scope of the contract?
Yeah, they're scrutinizing the scope, the duration, the legal terms, long before the ink dries.
Well, speaking of the ink drying, the scale of what they are signing is what really caught my attention in this transcript. CEO Julie Sweet highlighted that 30 clients signed bookings of over $100 million just in this quarter alone.
Yeah, that is a massive figure for a single quarter.
And that brings their year-to-date total to 104 of these mega deals, which is up 13%.
Mm-hmm.
But is this normal? What exactly is a company buying for $100 million? Because to me, it signals one of two things.
Okay, what's your read?
Either it's massive enterprise bloat where a client is just outsourcing basic management functions because they've completely lost control of their own operations, or it's this desperate, almost existential scramble to modernize legacy tech before a disruptor just puts them out of business entirely.
It leans heavily toward the existential scramble. We really have to look at the architecture of a $100 million contract, because this is not just an IT upgrade or a single project timeline.
It's not just installing new software.
No, it is a multi-pillar enterprise-wide transformation. Take a legacy commercial bank, for example.
Okay, a bank?
A $100 million engagement there involves decommissioning their 40-year-old COBOL mainframes, right?
Mm-hmm.
Then migrating petabytes of highly regulated financial data to a sovereign cloud environment.
Which is terrifying for a bank to do.
Terrifying and incredibly complex.
Yeah.
And then they're rebuilding all the consumer-facing mobile applications from scratch, deploying machine learning algorithms for real-time fraud detection. And this is the most expensive part, running the change management protocols to retrain 10,000 employees on how to actually use the new architecture.
Wow. So it really is the complete surgical replacement of the corporate nervous system.
Exactly.
While the patient is still awake and, expected to run a marathon.
That is the perfect analogy.
Yeah.
And that level of surgery requires an absolute army. You need onshore strategists, nearshore developers, offshore maintenance teams, and this is all built out over a 3 to 5 year horizon.
So the client isn't just buying a deliverable.
No, they're effectively buying a temporary, highly specialized workforce to execute a pivot that they are just structurally completely incapable of executing in-house.
Right. But, that 1.1 book-to-bill and those $100 million mega deals, they look a lot less secure when you actually dig into the raw realities of this quarter.
Oh, absolutely. The headwinds were very real.
Yeah, because while the headline numbers look solid, they do not tell the whole story. The geopolitical environment started fracturing their pipeline almost immediately. Management explicitly called out the conflict in the Middle East.
Right. And they actually quantified that impact.
They did. They stated a direct and indirect revenue hit of $100 million entirely in consulting, and then a subsequent future bookings impact of $400 million.
Which is a huge hit to the pipeline.
It really is. Now, the direct impact is obvious, right? Local offices close, regional projects halt, but the indirect impact is what fascinates me. How does a regional conflict ripple into global discretionary spend? Because we are seeing the kinetic reality of geopolitical supply chain shocks translating into, delayed software implementations thousands of miles away.
Well, the mechanism of that indirect impact just reveals how incredibly fragile corporate confidence really is right now.
Walk us through how that actually happens in practice.
Sure. So imagine you are a global automotive manufacturer headquartered in, say, Germany or Japan. A conflict in the Middle East instantly alters your entire corporate risk profile.
Because of oil.
Partially oil.
Yeah.
Energy prices spike due to speculative trading, sure. But crucially, the shipping routes through the Red Sea become uninsurable.
Oh, right. The logistics nightmare.
Exactly. So your logistics providers are suddenly forced to route these massive cargo ships entirely around the continent of Africa.
Adding weeks to the transit time.
Weeks of time, and your freight costs jump by 30 or 40% overnight. Meanwhile, those delayed transit times completely break your just-in-time inventory models on the actual assembly line.
So the auto manufacturer's profit margin just gets immediately compressed by these physical realities that they simply cannot control.
Right. And how does the chief financial officer react? They look at these rapidly deteriorating cash flow projections, and they instantly mandate a freeze on all discretionary operational spending.
Ah, I see.
So that $40 million supply chain software upgrade that Accenture was scheduled to begin next month, it just gets pushed to the next fiscal year.
Wow. So the X-ray literally tracks the geopolitical tension straight through the physical shipping lanes and deposits it as a revenue miss on an IT services balance sheet.
That's exactly how it works. And, this hesitation compounds when you look at the delays in their managed services division, too.
Right, because Angie Park noted that a couple of large managed services deals were pushed out of Q3 and into fiscal 2027.
Yes. And we really must delineate consulting from managed services here to understand why just one or two delayed contracts create such a massive optical swing in the financials.
Okay, let's break that down in plain language for the listener. What is the actual difference on the ground?
So consulting is project-based. You come in, you design the new cloud architecture, you build it, you hand it over.
And managed services.
Managed services is baseload operational running. It means you monitor the cloud architecture, you apply the security patches every Tuesday, and you handle all the server load balancing for the next 7 years. You are running their day-to-day.
And those contracts are governed by incredibly strict service level agreements, right? SLAs.
Oh, fiercely strict. If we connect this to the bigger picture, if Accenture assumes control of a client's payroll system under a managed services contract, and that system goes down for 4 hours on a payday.
People don't get paid.
Exactly. And the SLA usually dictates massive financial penalties for Accenture in that scenario.
So the liability is huge.
It is. And because of that liability and the sheer length of these engagements, often spanning 5 to 10 years and valued at upwards of $300 to $500 million, the legal and compliance reviews are just torturous.
Which explains the pushouts.
Right. If a Fortune 500 client decides they need an additional, say, 4 weeks to renegotiate the data sovereignty clauses within an SLA, and that delay pushes the final signature past the May 31st quarter close.
Accenture suddenly has a $500 million hole in their current quarter's reported bookings.
Exactly. The deal is not lost to a competitor. It merely slid to the right on the calendar. But of course, the algorithmic trading models on Wall Street, they just see the immediate quarterly booking miss and they initiate sell-offs based on perceived weakness.
It's just wild how a compliance lawyer taking a vacation can tank a tech stock for a day.
It really is.
But, with those massive managed services contracts stalling out in these compliance committees and the organic growth capped by nervous CFOs, growth has to be engineered from external sources.
Which brings us to the M&A blitz.
Exactly. This explains the sudden mid-year shockwave in their capital deployment strategy. I mean, they are nearly doubling their acquisition budget. They took their capital deployment expectations for the year from $5 billion up to a staggering $9 billion.
Yeah, and an arbitrary $4 billion mid-year expansion in an M&A budget.
Yeah.
That is not a casual adjustment.
No, not at all.
That is a structural pivot to capture a window of opportunity that management obviously believes will close if they rely solely on organic hiring.
And they are pointing that $9 billion cannon directly at the operational technology, or OT, security market. The transcript detailed some very specific acquisitions, a majority stake in Dragos, alongside the full acquisitions of RunZero and NetRise.
Right.
Now, for you listening, we need to ask the obvious question. What on earth is OT security? Because we all know IT security, right?
Information technology security.
All right. IT security protects your data. It keeps the hackers out of the HR servers and the customer credit card databases. But OT operational technology security protects the kinetic physical environment.
And that is a completely different world.
It is the physical power grid, the municipal water supply, the robotic arms in a car factory.
Exactly. And to understand why Accenture is suddenly trying to just absolutely corner the OT security market, you really have to look at the underlying architecture of industrial systems. Specifically, what's known as the Purdue Enterprise Reference Architecture model.
Okay, you're going to have to translate that one.
Basically, for decades, the hardware running the physical power grid, or the factory floor level 0 and level 1 of this Purdue model, was completely air-gapped.
Meaning it had no connection to the outside internet whatsoever.
Right. If you wanted to hack a municipal water valve 10 years ago, you couldn't do it from a basement in another country. You had to physically walk into the facility with a corrupted USB drive.
Which is pretty decent security, honestly.
It is. But then came the drive for industrial efficiency, right? Predictive maintenance. Companies started connecting those physical valves and robotic arms to their cloud-based IT networks.
Right. They dissolved the air gap.
Exactly. The moment you connect a programmable logic controller to an internet-facing dashboard, just so a plant manager can monitor factory output from their iPhone while they're at home, you have expanded the attack surface exponentially.
And securing that physical attack surface requires entirely different engineering than IT security, doesn't it?
Oh, fundamentally different. Think about it this way. If an IT security tool aggressively pings an IP address on a normal corporate server to check for a vulnerability, the server just logs the ping and moves on. It's built for that traffic.
Right.
But if you use that exact same active scanning tool on a delicate 15-year-old programmable logic controller that's actively running a manufacturing line,
Let me guess. It crashes.
the unexpected network traffic can cause the controller to just abruptly reboot. The robotic arm stops, the assembly line halts, and you just cost the client $2 million in lost production time.
Simply by trying to scan for a virus.
Exactly. Which is exactly why they are buying these three specific companies.
Okay, let's break down the portfolio they just bought. RunZero specializes in passive asset discovery, right? So it maps every single device on the factory network without sending that aggressive traffic that could knock the system offline.
Right. Passive is the key word there. And then Dragos brings the threat intelligence. They identify the specific behavioral signatures of state-sponsored hackers who are actively targeting industrial control systems.
And then NetRise.
NetRise analyzes the actual firmware binaries, so the really low-level software embedded deep inside the microchips of the physical machinery, looking to find hidden vulnerabilities that a normal scan would never see.
So the integration challenge here must be immense. I mean, historically, a chief information security officer had to buy these tools separately, right?
Yeah, and they'd attempt to just duct tape their APIs together to get some sort of unified view of the factory floor, which rarely worked well.
But now, Accenture is acquiring these foundational code bases to build a native, first-of-its-kind unified platform. So clients can just make one purchase instead of stitching together 3 different vendors.
Exactly. They are more than tripling their total addressable market, their TAM, in an area where demand is completely inelastic.
Right, because of what Julie Sweet said in the call. I want to quote her directly here. She said, "You cannot have an AI revolution without critical infrastructure, which is where today the world is most vulnerable."
It's a great point. I mean, you can delay a marketing software upgrade. If interest rates rise, you absolutely cannot delay securing the national power grid when state actors are actively probing for vulnerabilities.
But this M&A spree isn't just about expanding the addressable market, is it? It represents a fundamental shift in their underlying business model, specifically their unit economics.
Yes, the shift toward non-FTE models.
Right. The transcript briefly touched on this, using these acquisitions to pivot toward non-FTE or non-full-time equivalent commercial models. FTE is the traditional human-hour billing structure, right?
Exactly. You hire an analyst, pay them a fixed salary, and bill their time to a client at a massive markup.
Like hiring a personal trainer by the hour.
Right. But under that model, your revenue growth is strictly constrained by the physical number of human beings you can actually recruit, train, and deploy.
Right. Human labor scales linearly, and it brings a ton of friction. Humans require benefits, they experience burnout, their utilization rates fluctuate.
And macro wage inflation just eats away at the profit margins.
Exactly. So shifting to a non-FTE model or a platform billing model is like moving from paying a trainer by the hour to owning the gym and selling digital memberships.
That's a great way to put it. They are attempting to graft the economic engine of a software as a service company into the body of a traditional professional services firm.
So when they acquire Dragos, they are acquiring a proprietary software asset. They can license that Dragos platform to 1,000 different manufacturing clients simultaneously.
And the cost of replicating that software license approaches zero, meaning the gross margins scale exponentially rather than linearly.
They are actively trying to decouple their revenue growth from their headcount growth to defend those margins. It's a massive shift for a company known for billing out human consultants.
It is. But the friction lies in execution. Historically, professional services firms really struggle to build or integrate software products because their internal incentive structures are entirely built around selling human hours.
Right. A partner gets paid based on how many analysts they have billing 60 hours a week on a project.
Exactly. Partners are compensated based on the utilization rates of their teams, not on the recurring licensing revenue of a software tool. So for this pivot to work, Accenture has to radically alter its internal compensation and sales architecture to prioritize platform deployment over just raw headcount deployment.
Now, if we are discussing the decoupling of revenue from human labor, we inevitably arrive at the core thematic driver of this entire earnings call.
Artificial intelligence.
AI, the absolute dominant theme. Management was highly specific, stating they are moving clients from using AI to running on AI.
Right, not just pilots anymore, production.
Exactly. They added 100 new advanced AI projects this quarter alone, and they're doubling their bookings with ecosystem partners like OpenAI, Anthropic, and NVIDIA.
But what's fascinating here is that instead of just abstract hype, they provided some really highly specific data-backed case studies.
Yes, 3 case studies of AI generating immediate commercial return on investment. Let's walk the listener through these because this is where the rubber meets the road. Case study number 1, Cox Communications.
This one provides a masterclass in how generative AI is altering the fundamental mechanics of business-to-business sales.
Right. So Cox deployed an AI engine built alongside an LLM provider and a cloud hyperscaler. And the result was an increase in sales lead accuracy from 13% up to 97%.
Which is just an unbelievable jump.
Right. But a jump from 13 to 97% accuracy does not happen just by giving the marketing team access to a basic ChatGPT prompt interface. You have to look under the hood at the data architecture.
You do, and this requires what's called the Retrieval Augmented Generation, or RA, architecture.
RAG, explain that for us.
Because the fundamental problem with out-of-the-box large language models is that they hallucinate, right? And they have absolutely no knowledge of a company's private, proprietary data.
Right, they just know what was on the internet up to a certain date.
Exactly. So how the RAG architecture solves this is brilliant. Cox possesses decades of highly fragmented customer data. We're talking past purchase histories, support tickets, regional broadband deployment schedules, website interaction logs.
All sitting in different silos.
Right. So Accenture builds data pipelines to ingest all of this unstructured data and then converts it into vector embeddings.
Vector embeddings, basically turning text into mathematical coordinates, right?
Yes, and it stores it in a specialized vector database. Now, when the sales AI needs to evaluate a potential lead, it doesn't just guess. It queries this vector database first, retrieves the highly specific proprietary context about that specific customer, and then feeds that verified context into the large language model to generate a score and a personalized marketing strategy.
So the system actually grounds the AI in reality.
Exactly. It completely anchors it.
Which explains the efficiency jump. I mean, if a sales representative is operating with a 13% lead accuracy, 87% of their labor is completely wasted, calling prospects who will just never buy.
It is the definition of negative productivity.
Right. So by shifting that accuracy to 97%, the AI is not just, writing faster emails. It is fundamentally altering the conversion funnel. Every hour the sales team works is now deployed against a high probability target.
And the transcript noted that campaign speed to market improved by 55%. Marketing content teams became 40% more productive.
They are generating massively higher throughput without adding a single dollar of headcount expense to the SG&A line item. These aren't just fun experimental chatbots, they are production-grade commercial engines directly driving revenue.
Right. Now, the second case study moves from revenue generation into core infrastructure resilience. They detailed their work with BT Group, the telecommunications company.
British Telecom, right. They provide the connectivity backbone for UK businesses and public services.
Exactly. And Accenture is embedding AI directly into their core network operations through what they call AI ops. And this leverages autonomous agents designed for self-healing network capabilities.
Okay, the engineering behind a self-healing network, that is a massive leap from traditional IT management. Because historically, network operations centers, or NOCs, they rely on thousands of simple thresholds, don't they?
Yeah, very binary rules. If a server's CPU usage hits 95%, or a router drops too many packets, an alert fires.
And the human engineers in the NOC suffer from massive alert fatigue. They have to sift through the noise, manually diagnose if a node failure is a hardware issue or just a bad routing table, and then, manually type out the command line scripts to reroute the traffic.
It's slow and prone to human error, but AI Ops replaces that manual diagnosis with machine learning classification.
How does that work in practice?
The AI continuously ingests these massive streams of telemetry data, SNMP traps, syslog files, BGP routing updates, and it establishes a baseline of what normal network behavior looks like. When an anomaly occurs, the AI doesn't just trigger a dumb alarm. It instantly cross-references the anomaly against historical fault patterns to actually isolate the root cause.
But the autonomous agent takes it a step further, doesn't it?
It does. Once it identifies the fault, The agent has the authorization to execute a runbook, perhaps deploying an Ansible script or something similar to automatically quarantine the failing node, rewrite the routing tables to bypass the hardware, and deploy a software patch to the affected systems.
And it executes that entire remediation cycle in milliseconds.
Long before the cascading failure causes a total outage for the end user, the network effectively repairs its own torn tissue.
That is incredible. And the downstream impact is a drastic reduction in mean time to resolution, way lower maintenance overhead, and a highly resilient connectivity backbone for the UK economy.
Exactly. Now, the third case study is from Banco Bradesco in Brazil, and this illustrates how AI orchestration is weaponized in highly competitive consumer markets.
Bradesco competes in vehicle financing, right?
Yes. And that is a market where speed to decision is the absolute determinant of market share.
Because if a consumer is sitting in a dealership and the dealer submits the loan application, the bank that returns an approval in 60 seconds wins the financing.
Right. If your bank takes 45 minutes because of fragmented legacy systems, the dealer simply moves to a competitor who's faster.
And the bottleneck in these banks is almost always the legacy mainframe, right? Mainframes running COBOL are incredibly stable, but they were never designed to interact with modern real-time web applications.
No, not at all. And Accenture cannot simply rip out the mainframe. The risk to the bank's core ledger is just way too high.
So what do they do?
Instead, they build an API orchestration layer, a series of microservices that basically sits on top of the legacy systems.
Ah, I see.
This unified platform seamlessly routes the data in real time. So the moment the dealer submits the application, the orchestration layer fires off concurrent API calls. It pings the government vehicle registry to verify the asset. It queries the national credit bureaus to pull a consumer's risk profile. And it extracts the necessary historical data from the bank's own internal mainframe.
And then the AI risk engine processes all those disparate data streams instantly, delivering a firm credit decision before the customer has even finished their coffee.
Exactly. And the commercial result of stripping out that latency, it was a 7.3% quarter-over-quarter growth in Bradesco's vehicle financing portfolio.
Wow. In a mature financial market, a 7.3% sequential jump driven entirely by a technological upgrade is just staggering.
It really is.
But, deploying these massive AI architectures introduces a completely new cost vector. And this surfaced during the Q&A segment of the call.
Right, the analyst question from Jim Schneider.
Yeah, he asked about the budgetary impact of AI infrastructure spending, which prompted Julie Sweet to discuss this fascinating concept of tokenomics and the creation of an AI FinOps practice.
Yeah, this is a direct historical parallel to the cloud computing boom of 2016. Remember when companies just blindly migrated workloads to AWS or Azure, and then were subsequently crushed by these unpredictable, completely unoptimized cloud builds?
Oh, absolutely. Everyone got burned by the cloud at first.
Yeah.
And now they're doing the exact same thing with AI because the billing mechanism for large language models is entirely consumption-based, calculated by the token.
Right, the token.
Explain the token economy for us. A token basically represents a chunk of a word.
Exactly. When a client feeds a massive document into an AI to summarize it, they pay for the input tokens. When the AI generates a 5-page strategic analysis, they pay for the output tokens.
And the costs vary.
Wildly. The cost per 1,000 tokens varies wildly between models. A highly complex model like OpenAI's GPT-4 is incredibly powerful, but expensive, whereas smaller open source models like Llama 3 are significantly cheaper, but maybe less capable at complex reasoning.
So the problem is that enterprise clients are deploying AI so rapidly that they completely lack the governance to control these compute costs.
That's exactly it.
You end up with a situation where a junior marketing associate might be using the most expensive compute-heavy model to simply, format an Excel spreadsheet, a task that a model that costs 1/10 the price could do instantly.
Right. And you multiply that inefficiency across 50,000 employees, and suddenly the CFO is staring at a GPU compute bill that completely erases any of the productivity gains the AI generated in the first place.
Which is the genesis of this AI FinOps practice Accenture is building.
Exactly. Accenture is building these middleware platforms that act as a routing intelligence layer.
So when an employee submits a query, the platform instantly evaluates the complexity of the prompt and automatically routes it to the most cost-effective model capable of handling the task.
Right. And it implements prompt caching, too.
Oh, prompt caching. That's huge.
Yeah, so if 50 employees ask the system for the updated HR holiday policy, the system generates the answer once and then just serves it from a cache.
rather than paying the hyperscaler 50 separate times for the exact same compute cycle.
Exactly. Accenture is essentially monetizing the optimization of the very technology they are implementing.
It's brilliant. Now, while all these massive AI deployments and OT security transformations are geared toward the Fortune 500, we noted earlier that that specific client base is currently heavily restricting their discretionary capital.
Right, the geopolitical and macro freeze.
Exactly. So this reality is forcing Accenture to hunt for volume in previously underpenetrated demographics. Which brings us to the highly strategic launch of a brand new business unit launching next week called Accenture Edge.
Yeah, Accenture Edge. And this is aimed squarely at the mid-market.
Now, they define the mid-market in the transcript as companies generating between $300 million and $3 billion in annual revenue.
Which represents a $240 billion total addressable market.
That's a massive pool of untapped growth. We are talking about regional logistics companies, specialized biomedical manufacturers, mid-sized retail chains.
And they are facing the exact same technological threats as the global giants. I mean, they require advanced supply chain forecasting, they're targeted by the exact same ransomware syndicates, and they must deploy generative AI to remain competitive.
Right, but the friction is that a $500 million regional manufacturer simply cannot afford the bespoke, multi-year, $50 million consulting engagements that Accenture traditionally sells to global banks.
No, not a chance. And furthermore, the sales motion to capture the mid-market is completely different.
How so?
Well, you can't afford to put a senior partner on an airplane for 6 months to court a client for a $2 million implementation. The customer acquisition cost just destroys the profit margin before the project even begins.
So what's their strategic solution to actually capture this $240 billion market?
The ecosystem-led approach, specifically leveraging Avanade, which is their highly successful joint venture with Microsoft.
Ah, right, because the mid-market is heavily standardized on Microsoft architecture already. Azure for cloud, Office 365 for productivity.
Exactly. And when Microsoft aggressively pushes its Copilot AI software to these mid-sized companies, the clients quickly realize they can't simply just turn the AI on.
Right. Because if their internal SharePoint permissions are a mess, turning on Copilot means junior employees can suddenly query the AI and, read the CEO's unreleased financial projection.
Or read everyone's salaries. It's a governance nightmare.
So the data governance has to be scrubbed and structured before the AI can be safely deployed.
And that is where Accenture Edge steps into that exact gap.
So by packaging the intellectual property, the cybersecurity frameworks, and the deployment playbooks they develop for the Fortune 500 into these standardized off-the-shelf solutions, they can sell them right alongside Microsoft software licenses.
Exactly. It drastically lowers the cost of customer acquisition, and it creates a high-velocity, repeatable sales channel that offsets the stalled mega deals at the top end of the enterprise market.
It's a brilliant pivot. Now, synthesizing all this strategic maneuvering really requires looking at the forward guidance management provided to Wall Street, because bringing it all back to the investor perspective, what does management say is going to happen next?
Right. Let's look at Q4. CFO Angie Park projected revenue in the range of $17.75 billion to $18.4 billion.
Which represents 1% to 5% growth in local currency.
Yeah, but the critical nuance, and this is so important for anyone analyzing this stock, was her explicit warning that they expect, quote, more of the guided range to be in play.
Okay, let's decode that. In the highly calibrated language of earnings calls, stating that more of the range is in play is a direct signal to analysts, isn't it?
It absolutely is. It's telling them to model their expectations toward the bottom half of that bracket.
It is a tacit admission that the intra-quarter deterioration, the delayed managed services contracts we talked about, the geopolitical chill on discretionary spend, all that, is still actively degrading the pipeline.
Exactly. They do not want institutional investors modeling a smooth cruise to 5% growth when the macro reality is basically fighting them for every single inch.
Right. And looking at the full year, FY26 full year guidance is sitting at 3% to 4% growth, with EPS earnings per share of $13.78 to $13.90, representing 7% to 8% growth.
But despite that near-term pipeline friction, the capital allocation strategy here remains just aggressively shareholder-friendly.
Oh, incredibly friendly. They reported returning $8.2 billion in cash to shareholders year to date.
Yeah, through dividends and buybacks.
Right, a massive acceleration in share buybacks. They repurchased $1.2 billion of their own stock in this quarter alone, alongside a 10% increase in the quarterly dividend.
And you have to understand, the share buyback is the ultimate financial lever for a management team.
Right. When organic top-line revenue growth slows down to 3% because clients are delaying contracts, management can still magically manufacture 7 to 8% growth in earnings per share.
Simply by using their massive free cash flow to shrink the total number of outstanding shares.
It makes the remaining slices of the pie mathematically larger?
Exactly. It is a highly defensive posture that keeps institutional investors pacified while the company executes those much harder structural pivots into OT security and AI platform development that we just discussed.
So synthesizing the overall health of the business, what is the bottom line here? Bullish or bearish?
I'd say the overall health reflects a brutal pragmatism. They are not waiting for the macroeconomic environment to become favorable.
Right, they're taking action now.
Exactly. By rapidly expanding their M&A budget to capture that inelastic demand in physical infrastructure security, actively cannibalizing their own billable hour model in favor of scalable software economics, and proving hard commercial ROI for artificial intelligence, they are setting themselves up.
They're ensuring that when the Fortune 500 eventually unlock their frozen capital, the architecture they absolutely must buy is overwhelmingly owned by Accenture.
Precisely. It's a defensive setup with a massive offensive upside once the macro clears.
Well, as we wrap up this journey, from the $18.7 billion in revenue through the headwinds of geopolitical conflicts into that massive $9 billion M&A pivot and the shift toward AI production, I want to leave you with a final thought to mull over.
And this is the part that really keeps me up at night, honestly.
Me too. If you project the trajectory of this specific earnings call out over the next, say, 5 to 10 years, you are looking at the potential death of the human hour.
The absolute end of an era.
Because for a century, the fundamental law of physics in the professional services industry was headcount. A firm's valuation, its prestige, its revenue capacity, all of it was entirely dictated by the sheer volume of brilliant human beings it could recruit, train, and bill out to clients at an hourly premium.
Right. It was a purely human-powered engine.
But if the acquisitions of proprietary software platforms continue to replace billable analysts, and if autonomous AI agents become sophisticated enough to not just write marketing copy, but to actively diagnose network hardware failures, self-heal routing topologies, and orchestrate real-time financial API calls without a human ever touching a keyboard.
The economic anchor of the entire industry just shatters.
Exactly. So the provocative question is this. How does a consulting firm price its value in 2030 when the heavy lifting of corporate transformation is no longer executed by an army of MBAs, but by a fleet of highly optimized proprietary algorithms?
It is a paradigm shift that will just rewrite the economics of knowledge work entirely.
It really will. Keep that dynamic in mind the next time you hear a management team talk casually about efficiency gains. You might just be listening to an industry actively engineering its own evolution. Thank you for joining us on this deep dive. Keep questioning the framework. Keep translating the numbers, and always demand the operational reality behind the corporate narrative. We will catch you on the next one.